Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Tariff turbulence ahead. President Trump doubles down on his trade policy, but admits tariffs will cause disruption. The US Commerce Secretary hints at relief for Mexico and Canada.
The tariffs will go on agricultural product coming into America, and our farmers starting on April 2nd. It may be a little bit of an adjustment period.
Releasing the debt brake. Germany relaxes its borrowing rules to boost spending, vowing to do whatever it takes to defend the country. Plus, China pledges to support domestic demand in the face of US tariffs, setting a bullish target for growth and lifting borrowing to the highest level in more than 30 years. Happy Wednesday, a huge day for these markets, with the Commerce Secretary of the US suggesting that maybe there's relief in the pipeline, potentially as soon as today for Mexico and Canada. Does that signal that the Trump put is back in play after 2 days of losses, the longest, the most pronounced drop we've seen over a 2-day period in US stocks since December? The S&P 500 back below levels prior to President Trump winning that election. European futures pointed to solid gains, largely on the commentary from the Commerce Secretary, but also this momentous decision for Germany to scrap its debt brake to fund defence and infrastructure. A 2% drop, more than 2% drop across European stocks yesterday. The auto sector hammered, dropping about 5%. Today, though, it's a very different picture, looking to gain close to 2%. Up 1.8% is what's been signalled by the futures. FTSE 100 futures pointing to gains as well of around 0.7%. S&P futures, after the losses of yesterday, looking to add 37 points, and NASDAQ 100 futures pointing to gains of 0.7%. Let's flip the board and have a look cross-asset. The focus on the benchmark 10-year, expectations building that the Fed will have to cut more than maybe some had expected. Mohamed El-Erian suggesting that the odds of a recession in the US have moved up for him from 10% to 30%. The 10-year currently yielding 4.23. Euro dollar, the euro surging yesterday on this decision by Germany, currently at 1.06. Deutsche Bank saying the euro could test 1.10. Strength for the single currency is what's being flagged by some FX strategists out there now on the fiscal stimulus out of Germany. Eurobond futures, you're looking at a sell-off again. Yields expected to be higher once again in German sovereign debt on expectations of greater issuance. Brent trading at $70 a barrel, down 0.3%. Now, tariffs are making America rich again. Quoting from President Donald Trump, defending his use of tariffs in a primetime presidential address to a joint session of Congress. Trump warned of, quote, a little disturbance from the levies after his tariffs against the US's largest trading partners sent markets swinging.
If you don't make your product in America, however, under the Trump administration, you will pay a tariff, and in some cases, a rather large one. Countless other nations charge us tremendously higher tariffs than we charge them. April 2nd, reciprocal tariffs kick in. The tariffs will go on agricultural product coming into America, and our farmers starting on April 2nd. It may be a little bit of an adjustment period. I have also imposed a 25% tariff on foreign aluminum, copper, lumber, and steel. Tariffs are about making America rich again and making America great again, and it's happening, and it will happen rather quickly. There'll be a little disturbance, but we're okay with that.
OK, at this point, let's bring in Bloomberg senior editor Bill Ferry's full reaction to that speech by President Donald Trump. Bill, Trump apparently doubling down on his tariff threats. He mentioned the European Union as well. The EU seems to be next in line. And yet his Commerce Secretary suggesting that Mexico and Canada tariffs could be walked back, at least in some form, as soon as today.
Yeah, that was a very interesting development with less than a day of those new tariffs being in effect. You had the Commerce Secretary saying, hey, maybe we can start rolling them back. I've been on the phone with officials from Mexico and Canada, and they're doing a lot to try to to meet our demands. If you were looking for some clarity on what that meant or the timing in President Trump's speech, you didn't get it. What you did hear, as you showed there, was a doubling down on his view that tariffs are a very effective tool for bringing in revenue for the United States and getting manufacturing and production moved into the U.S. And even bragging about the upcoming tariff schedule. So I don't think it's clear at all that there's any tariff relief coming. We've been pushing the White House for more details on the Commerce Secretary's comments. We're going to have to wait and see what plays out. Obviously, there has been a strong market reaction. President Trump is known as someone who watches the markets. Maybe the pain point hasn't been reached yet. Maybe they do have a more formal schedule in the works that we just don't know about yet. We'll have to wait and see.
OK, and we'll see what that pain point is, won't we, when it comes to the equity market reaction to these tariffs. Meanwhile, on the geopolitics and, of course, the focus on the conflict and the war in Ukraine, President Trump also speaking about his efforts, Bill, to end that conflict. He says he's received a letter then from President Zelenskiy saying Kyiv is ready to negotiate and sign a deal on natural resources. Let's take a listen.
It's time to stop this madness. It's time to halt the killing. It's time to end this senseless war. If you want to end wars, you have to talk to both sides.
Bill, are we now moving closer to a deal on minerals with Ukraine and a deal that can get us closer to that ceasefire?
It certainly sounds like it when it comes to that minerals deal. Of course, that all blew up last Friday in the Oval Office. But the real incentive behind that deal was to keep Ukraine, if not at the negotiating table, at least somewhat close to the negotiating table, as the U.S. and Russia primarily seem to move forward on trying to end this war. Without that deal, it seems like there's almost no way the Trump administration will keep Ukraine or even potentially Europe really informed of what's going on or take their views into account. So I think in terms of Ukraine, this is probably in its best interest to find a way to narrow that rift that erupted last Friday. And it does probably signal that, that this acceleration in peace talks between the U.S. and Russia will continue.
Yeah, President Zelenskiy, of course, with that social media post yesterday saying he regrets what unfolded in the Oval Office and does not want to see a prolonged conflict. Bloomberg senior editor Bill Ferries, thank you very much indeed for the latest. Of course, President Trump speaking just in the last hour or so. Meanwhile, US Commerce Secretary, as we mentioned, Howard Lutnick, has reiterated that President Trump may offer tariff relief to Canada and Mexico, potentially as soon as today. But he discounted the notion that the levies would be fully rolled back. He spoke to Fox News ahead of Trump's Congress address.
Now, both the Mexicans and the Canadians were on the phone with me all day today trying to show that they'll do better. And the president's listening because, you know, he's very, very fair and very reasonable. So I think he's going to work something out with them. It's not going to be a pause, none of that pause stuff. But I think he's going to figure out, you do more and I'll meet you in the middle some way. And we're going to probably be announcing that tomorrow.
For the market reaction, let's bring in Bloomberg's Valerie Teitel. Valerie, wow, what a day for these markets. What's the reaction been so far?
Look, the reaction from those Howard Lutnick comments maybe is confirming the market's suspicion that these tariffs might not be implemented for very long, and there is a deal in the cards. We also saw the Canadian dollar actually strengthen on the day after those comments, and so did the Mexican peso. So we await more details from the Treasury Secretary and from the Trade Secretary, Howard Lutnick, on just what deal is announced. But it's also helped the equity market turn around from its slide yesterday. The equity market was down some 2% before these comments. We did bounce strongly into the close. Some attention on a large Treasury block trade, one of the largest ever, Tom. Looked like a rotation from Treasuries into stocks. So that also helping risk on sentiment in the overnight session in Asia. We also have our eye on European assets, Tom, after the late announcement from the German government that they intend to spend $500 billion on defense. Eurodollar sustained a break of 105 finally, and it did it in style, Tom, now trading above 105. 106. It broke above that 100-day moving average and sustained that break of 105 finally. Also, keep your eye on German yields, especially in the long end. We had those Buxel futures really collapse in late trade yesterday, pointing to a near 10 basis point rise on the open. Just how much demand will there be for this extra issuance coming from the German government to fund this defense spending? Keep an eye on how the cash bonds open in just over an hour's time.
Remarkable day for the euro. Deutsche Bank analysts saying it is the biggest change to fiscal policy in Germany since reunification. Bloomberg's Valerie Teitel with the market reaction to both, of course, what is transpiring in Germany on the fiscal impulse around defence and infrastructure, and, of course, the reaction to what we've been hearing around tariffs from the Commerce Secretary stateside. Let's cross over to Asia right now. Avra Hong checking in on the markets in Singapore. Some upside, green on the screen. Is this a tariff story or is this a China growth story?
I think it's a bit of both, Tom. I mean, as you heard Trump kind of wrapping up his speech, it was so interesting to see how the region's benchmark actually extended gains. So they're shrugging off the tariff risk for now. They are running on hope. And then, of course, ahead of that, we got the Chinese NPC. Now we know what their economic goals are and the stimulus approach that is going to get them there. We saw how they had a record in terms of the budget deficit target. There's going to be special government bond issuances as well. There's a focus on some of these tech sectors, including AI. You talked that up, along with EVs and spurring growth. So overall, very positive for stock markets. And we saw the Hang Seng actually hit the highest level in about a week and doubling down as well. If you take a look at some of the special mentions that we heard in the speech, it also included robotics, computing, the chip-making stocks. Those are the ones that are doing well today. Special bonds as well for the big banks. These are the lenders that have been doing the heavy lifting in China the past couple of years. Their margins have been coming under pressure. So some fleshing out of the recapitalization plans. These are also leading gains in China. Tom.
OK, the stock market reaction, some individual names on the move on the back of that work report and the details, of course, coming out of Beijing. Avra Hong in Singapore. We'll stay on that story and get the details in terms of what has been announced more broadly. China setting its economic growth goal then at about 5% for 2025, amid the opening salvo, of course, of that trade war with the US. Premier Li Qiang announcing the target at the meeting of the National People's Congress one day after President Trump doubled tariffs on China.
经济增长预期目标为5%左右，既是
The target of GDP growth of 5% fully takes into account the need to stabilize employment, prevent risks, and improve people's well-being, as well as the potential for growth and conditions supporting growth. So, it underscores our resolve to meet difficulties head-on and strive hard to deliver.
OK, for more, let's bring in Bloomberg's chief North Asia correspondent, Stephen Engel, who's on the ground for us in Beijing. Of course, Steve, this is not your first rodeo when it comes to the NPC and the work report. Is this 5% GDP growth figure achievable?
Yeah, that's the big question. Obviously, it's a very ambitious growth target. Keep in mind that was the same target that they set last year. They did meet it by the end of the year. However, they were not faced with a Trump trade war then, last year. They are now, and they're also faced with the issues, prolonged issues of the housing sector and trying to stabilize that and also restore confidence and boost domestic demand and domestic consumption. So all of these policies that we heard today is the roadmap for the provinces and the roadmap for policymakers over the course of this National People's Congress, which will last until March 11th, and then they'll go back to their provinces and try to carry it out. How are they going to do that? Well, they're going to be opening up the fiscal taps that the market has been hoping for. They're going to raise the fiscal budget deficit target to 4% from 3%. That is the highest since 1994, so the highest in 3 decades. It's the highest even, during the COVID and COVID-0 pandemic response. And they're going to also be issuing a number of bonds to help out the local governments. The central government will be shouldering this. So special local government bonds to the tune of 4.4 trillion yuan quota. That is the highest ever. The question now, Tom, is will the local governments properly and efficiently and effectively tap into that quota and provide the growth, the domestic growth growth that the central government so badly needs, obviously, as exports could potentially be weaker in the face of that Trump trade war.
Well, Steve, what is our understanding of the potential tariff effects on China hitting that growth target?
Well, there's always unforeseen shocks that could potentially derail the plans to hit that growth target. But I've been covering this a long time. You know, I've been out here 35 years and I've been covering China for Bloomberg for 22 years. I've never really seen the government miss its growth target unless there were major shocks to the unforeseen shocks to the system. So they seem very confident. There was headwinds last year. Obviously, they overcame that. They had stimulus in September and they met the target. But again, the unknowns are greater this time around. They do not know necessarily how far these tariffs are going to go. There's been no negotiation between Donald Trump and Xi Jinping since the first 10% tariffs, and now it's been increased to 20%. That's on top of the legacy tariffs already in place in the first term and carried through by the Biden administration. Trump has promised 60% tariffs, so we're not even there yet. We're only about a third of the way there yet. So again, there's a lot of potential shocks to the system as well as domestically. We don't know if this economy is willing and ready to spend and invest. Do they have the confidence?
Okay.
We're going to have to see. The marching orders are in place, though.
The marching orders are in place. Bloomberg's chief North Asia correspondent, Stephen Engel, on the ground for us, of course, with the Forbidden City just behind him over his right shoulder there. Coming up, President Trump's tariff threats and China's sluggish growth weigh on investors, though you're seeing green on the screen, of course, in the Asian session so far today. Morgan Stanley's chief China equity strategist, Laura Wang, joins me next to discuss how she is positioning around the growth target and tariff risk. Plus, later in the show, AI startup Anthropic raising $3.5 billion in a fresh fundraising round led by Lightspeed Venture Partners. Very pleased to say I'm going to be speaking to Lightspeed's co-founder, Ravi Mhatre, on the show later this hour. This is Bloomberg. Stock market staging a relief rally after the US Commerce Secretary said the Trump administration may walk back some tariffs. China, meanwhile, has set its growth target for this year, spurring bets of more stimulus. Let's bring in Laura Wang, Managing Director and Chief China Equity Strategist at Morgan Stanley. Laura, thank you so much for your time. Your reaction to the targets being set out of Beijing on growth, your expectations about stimulus, how does any of this change your view on the Chinese equity story?
Thanks very much. I think the target settings are perfectly in line with what we were expecting coming into the meeting. And the government had announced a 5% GDP growth target for 2025, a 4% fiscal budget deficit on the official basis, and overall a additional 2 trillion RMB worth of fiscal stimulus package. And all of those are exactly what we were expecting if you look at our previous reports published before the NPC. What I was hoping to hear as I walked into my office this morning was some further emphasis and restatement of a very strong message that the government was trying to send to the economy and the market lately, which is its support for the private economy as well as for technology innovation. And I think both of those messages got delivered perfectly this morning. So if you listen carefully to what the government speech has said, they actually pledged to further support the development of technology as well as to provide support for AI application and to new generations of intelligent terminals, including the electric vehicles, humanoids, and edge AI devices. So those are very, very encouraging. They've also emphasized the importance to provide a very healthy environment for platform economy as they are crucial to stabilize the job market and also to boost consumption. And that's exactly what the economy needs to meet the 5% growth target for this year.
OK, yeah, it's not just about the growth target, it's also about that focus on innovation and technology then. What does it mean for your price targets, Laura, at an index level as you look towards the second half of this year?
Yeah, so I think this morning's NPC speech hasn't really changed our view for this year negatively. We recently upgraded China from underweight to equal weight in our global emerging market allocation framework. This is because we're seeing a number of very important structural improvements along multiple fronts that made us a lot more comfortable and confident to advise global investors to increase your allocation to Chinese equities. I think China is actually bottoming out from a return on equity investment perspective. And this is not because of any potential sort of top-down fiscal policy stimulus stepping up or because of any sudden signal of deflation coming out. This is a lot more driven by idiosyncratic bottom-up companies' own effort. So basically, the companies have been self-helping themselves over the last several years by paying out more dividends, cutting costs very aggressively, and increase share buybacks. So we are very confident that China's ROE will continue to increase over the next couple of years and potentially cross that of the overall emerging market.
OK, so how do you invest around, Laura, how do you invest around the tariff risk that's coming through from the Trump administration?
That remains as one of the big risk factors for our view about Chinese equities for the remainder of this year. As I mentioned, we moved from underweight to equal weight, and we want to be very clear that the tariff risks and the U.S.-China confrontation remains probably one of the biggest uncertainties before we can actually further increase our confidence level and move China to an overweight position. Of course, when we talk about the tariff debate, it brings back some old memories when President Trump was in the office the first time. If we recall what had happened during the year of 2018 to 2019, actually, the weighted average tariff against Chinese imports into the U.S. had gone up by, on average, 10.3% during the course of 7 quarters. But if you look at what has already happened so far, actually, the tariff has already gone up by 10%, followed by another 10% in less than 2 months. So I would say in terms of magnitude and speed of tariff hike implementation, this time we are being challenged with a much worse situation. And then, of course, China is also fighting against the deflation. And I think the tariff debate and uncertainty actually cast further cloud over the overcapacity issue, which could potentially slow down China's growth potential and momentum this year because it slows down export growth. That being said, I think one more comment I want to make on this subject is I think this time around, the impact on the market, surprisingly or not so surprisingly, should be milder than the previous round. This is because over the last 7 years, the global multinational corporations, as well as the Chinese manufacturers, they actually have rewired a lot of their supply chain, so they're much better prepared. I'll just give you one number. So the total representation of exports to the U.S. from China in terms of the total China exports has come down from close to 20% back in 2017 down to around 15% now. So I think the manufacturers and the MNCs are better prepared. And the market, I think, also walked into this year with a more harsh expectation for tariff against China.
Laura?
But the reciprocal tariff actually put other trade partners even in a worse situation. So let's see.
Laura, we've run out of time. Really appreciate your insights on the back of the NPC. Laura Wang, Managing Director and Chief China Equity Strategist at Morgan Stanley. Thank you. Coming up, President Trump urging Congress to pass tax cuts as part of his agenda to get America, quote, back on track. We have more analysis of his speech to Congress later in the programme. This is Bloomberg. Bloomberg has learned that Goldman Sachs is set to start its annual round of job cuts, moving the exercise earlier in the year after previous reductions took place in the second half. The lender is said to be cutting between 3 and 5% of staff in line with prior moves. Coming up, Germany abandons its fiscal shackles in a drastic shift to transform Europe's defences. We discuss the significance of that move next. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Tariff turbulence ahead. President Trump doubles down on his trade policy, but admits tariffs will cause disruption. The US Commerce Secretary hints at relief for Mexico and Canada.
The tariffs will go on agricultural product coming into America, and our farmers starting on April 2nd. It may be a little bit of an adjustment period.
Releasing the debt brake. Germany relaxing its borrowing rules to boost spending, vowing to do whatever it takes to defend the country. Plus, China pledges to support domestic demand in the face of US tariffs, setting a bullish target for growth and lifting borrowing to the highest level in more than 30 years. Some consequential changes then on the tariff front in China around growth targets, and of course this momentous decision by Germany to rapidly step up spending on defence and infrastructure. All of these feeding in to the picture as we build up to the open. 8 a.m. UK time. Futures in Europe pointed gains of 1.6% after dropping a little over 2% yesterday on the tariff threat, weighing up, of course, the comments from the Commerce Secretary around potential modest relief, possibly for Mexico and Canada. FTSE 100 futures pointing gains of 56 points. S&P futures, after posting the biggest two-day decline since December, currently pointed gains of 0.5%, but that index back below levels it was prior to that election win for President Trump. What is the Trump put at this point for these markets? Nasdaq 100 futures pointing to gains of currently 127 points, up 0.6%. Let's flip the board and have a look cross-asset then. The benchmark US 10-year currently yielding 4.23. Yields moving just 1 basis point. Euro in focus, currently at 106. Deutsche Bank saying the single currency could test 110 on hundreds of billions of dollars of new spending coming through from this German government as they look to relax that debt brake. Bund futures pointing lower. Expectations yields will creep higher, of course, and more issuance when it comes to the sovereign German debt market. Brent at $70 a barrel, down 0.3%. To the earnings story right now, Redhead crossing the terminal just in the last couple of minutes from Adidas, talking of Germany. And this is a miss in terms of its operating profit forecast for 2025. Expectations from Adidas that they'll be racking in between 1.7 billion and 1.8 billion euros in terms of operating profit for 2025. That is below estimates of above 2 billion euros. In terms of the fourth quarter, the gross margin came in above year on year. 49%, close to 50% was the gross margin in the fourth quarter. Operating profit in the fourth quarter came in at 57 million euros versus a loss of 377 million euros year on year. So the progress has been there for this stock, currently up around 28% in the last 12 months, though unchanged year to date. Though there will be disappointment you would expect from investors that the operating profit target for 2025 is coming below the estimates. Let's turn to another German company, Bayer in the chemicals, of course, and agri space, seeing 2025 adjusted EBITDA of 9.5 billion euros to 10 billion euros at the top end of the range. That is above the estimates at the top end of 9.53 billion euros. This stock up 21% year to date. We're focused on the outlook for the year, of course, which we've just brought you. Tariff commentary as well from officials and executives at their company will be in focus. Crop science and pharma. Currently, you're looking at revenues for 2025. This is the expectation of 45 to 47 billion euros, slightly above the estimates, at least the top end of that range. Two stocks to watch at the open. Now, Donald Trump is urging Congress to pass tax cuts as part of his agenda to boost the US economy and help Americans hit by inflation. The president made the remarks in the longest ever presidential address to a joint session of Congress.
The next phase of our plan to deliver the greatest economy in history is for this Congress to pass tax cuts for everybody. We're seeking permanent income tax cuts all across the board, and to get urgently needed relief to Americans hit especially hard by inflation. I'm calling for no tax on tips, no tax on overtime, and no tax on Social Security benefits for our great seniors. And I also want to make interest payments on car loans tax deductible, but only if the car is made in America. We want to cut taxes on domestic production and all manufacturing. And just as we did before, we will provide 100% expensing.
Let's bring in Bloomberg senior editor Bill Ferries joining me now. Wow, the list then of tax cuts that this president wants is long. Is he going to get them, Bill?
He's unlikely to get all of them. I mean, even during the campaign, at almost every stop, Donald Trump seemed to talk about a different kind of tax reduction, whether it was for tips for, wait staff at restaurants, whether it was on Social Security payments for older people. He mentioned all of those again. When economists have added that up, it's a huge amount. It's not really showing up in its entirety in the budget bills and the budget resolutions that have been going through Congress. At some point, I think he's going to put the pressure on lawmakers to have to decide what gets passed and what gets held off for the future. The big looming deadline for Donald Trump right now are his signature 2017 tax cuts. Those are set to expire later this year. He's called to make those permanent. That right there will take a lot of money off the table. I think from there he's going to probably have to pick and choose between some of these other options he's talking about.
OK, Bloomberg senior editor Bill Ferries on the calls there for tax cuts from the Trump administration and to what extent and how many of those will actually get passed in that bill that's working its way through machinations, of course, in terms of Congress and how they're tackling this bill. Thank you. Now, to a momentous decision coming through from Europe's biggest economy, taking a major step to bolster its defence capabilities. Berlin amending its constitution to exempt defence and security outlays from limits on fiscal spending. Germany's Chancellor-in-waiting, Friedrich Merz, explained the need behind the move.
I want to be very clear here. Whatever it takes must also go for our defense now, in view of the threats to our freedom and to peace on our continent.
OK, for the details, let's bring in Bloomberg Opinion's Chris Bryant, who is in Berlin for us. Chris, how significant is this move?
Well, Tom, I think it's hugely significant. I think international partners, investors had two concerns about Germany. One, it's not spending enough on defense, and two, its economy is flatlining. Friedrich Merz, only 10 days after winning this election, comes out last night and says, we're going to have a 500 billion euro infrastructure fund to repair our decrepit infrastructure, and we're going to free the defense sector from limits that Germany has imposed on itself in terms of new borrowing. That's very, very important. Germany currently spending only 2% of GDP on defense. Realistically, it's got to spend nearer to 3%, maybe more. Right now, it has this fiscal straitjacket, the debt brake, which prevents it from doing so. Henceforth, it will be able to spend effectively as much as it wants on defense without breaching those limits. And so I think international partners will be now looking to Germany and saying, yes, finally, Germany has recognized the seriousness of the situation that it finds itself in, with Trump essentially washing its hands of Europe and also of Ukraine. Germany ready to step up now in a big way.
Yeah, Deutsche Bank's analysts saying this is the biggest fiscal change for Germany since reunification. Chris, what do we watch for next then? Is this a done deal?
Well, not yet. This deal, and that's the slight difficulty of it, needs to be put through the old parliament. To change the constitution, it requires a 2/3 majority. Due to the success of the far right and far left in recent elections, that doesn't exist in the new parliament, so this needs to go through the old one. That's a little bit controversial. German voters have just voted for something different. Mr. Merz wasn't exactly a fan of extra borrowing during the campaign. Nevertheless, it's exactly what needs to be done, and therefore I think this is all going to happen now.
OK, Chris Bryant from Bloomberg Opinion. Really appreciate the context on a huge decision coming through then for the lawmakers of Berlin, and we watch to see how that progresses. Let's get back to the defence space. It ties in, of course, to what we've been hearing in terms of the defence spend. This is continuing, of course, to give tailwinds to the defence story out of Europe. Just look at Hensoldt. That is the move over 1 year. 85%. It's called higher on TradeGate, again, as you can see, by 16% on expectations that Germany will be able to release hundreds of billions of euros for additional spending on defence. Mhatre called higher as well. Saab called higher. The defence story in Europe, in terms of the equity moves higher year to date, that continues. Just another catalyst, and a significant one at that, coming through around this decision to relax the debt rate to increase additional funding for defence and infrastructure. So again, the catalyst of defence will be at play for these European equity markets, with futures pointing strongly higher today and this is a key component in that story. We're going to get the view from the German defence sector later this morning. The Hensoldt CEO will be speaking exclusively to Bloomberg on the opening trade. Do not miss that interview, 8:15 London time. Now, China has once again set its economic growth goal for this year at about 5% at the National People's Congress, and that has started officially. Had its first day in Beijing today. It's also targeting a fiscal deficit of around 4% of GDP. That's the highest in 3 decades, and a sign of stimulus spending to come. Bloomberg's China correspondent Min Min Lo joins us from the Chinese capital. Min Min, China says they're going to loosen monetary policy then. What impact will this have? How much stimulus should we be expecting?
Well, a looser monetary policy isn't exactly new. The PBOC Governor Pang Gongsheng had sort of flagged that late last year. And what this means is the PBOC will cut interest rates and RRR at an appropriate time in a timely manner this year. That was stated in the government work report that was read out by Premier Li Qiang. Economists expecting maybe 30 basis points cuts to the interest rates and 100 basis point cut to the reserve requirement ratio. The question is, though, when are they going to do this? Because year to date, so far, you look at what the PBOC has done, their focus had been laser sharp on supporting the value of the yuan. In fact, the PBOC has been withdrawing liquidity from the financial system to defend the yuan. And it looks like at this point, they wouldn't want to be accused of being a currency manipulator or to devalue the yuan in order to offset tariffs, especially given Trump's recent comments, specifically naming the yuan and the yen in its currency watch list. And so it looks like the PBOC is still in a holding pattern here as they assess what the final impact of tariffs are going to be before they modulate their final response. And then the question is how fast they will move when they shift their stance towards this looser monetary policy and to ensure sufficient liquidity in the financial system. In the meantime, the government has pledged this 500 billion yuan in special sovereign bonds that will be used to inject capital into the big state banks to help bolster their ability to lend to the real economy and to protect against financial risks, given that these state banks have seen their profit margins being squeezed to record low levels after they've been enlisted by the government to provide cheap lending to risky borrowers like the real estate developers or the cash-strapped local government financing vehicles. And so the government now pouring their weight behind the big state banks to support and to stabilize the financial sector.
OK, Bloomberg's China correspondent Min Min Lo on the ground for us in Beijing. Chinese policymakers giving themselves optionality then as they adjust to these additional tariffs from the US administration, setting themselves a growth target of about 5%. Coming up, AI startup Anthropic raising $3.5 billion in fundraising. The latest round led by Lightspeed Venture Partners. Very pleased to say I'm going to be joined by Lightspeed's co-founder, Ravi Mhatre, next here in the studio. Stay with us. This is Bloomberg. Welcome back. Anthropic, the AI startup that rivals OpenAI, is now worth more than $61 billion. That's after its latest round of fundraising. Among the investors is Lightspeed Venture Partners, which contributed $1 billion of that $3.5 billion that was raised in the latest round. With me in the studio, very pleased to say, is Ravi Mhatre, co-founder and partner at Lightspeed. Ravi, thanks for coming to the studio. What is the rationale behind this additional bet on Anthropic? How do you see this business evolving in the next 5 to 10 years? What does Anthropic look like?
Yeah, and first of all, thanks for having me, Tom. Lightspeed's been invested for more than 2 years now in the company. Our latest round of investment in the company is really based on our conviction in Anthropic's focus on the frontier of artificial intelligence. This is really scaling intelligence itself, making models smarter, not developing small features. So things like creating models that have the ability to be, their own independent agents in the world. It's creating models like Sonnet 3.7, the most recent model they launched, which is world-class at writing very complicated software code. And we think that it's also importantly technology that relates to making models trustworthy as they get more and more sophisticated. If large businesses or if governments are going to take these capabilities and deliver them to their constituents, we have to have a way to understand predictably that the models are working in a way that is friendly to people and friendly to humanity. So all of these technologies really relate to scaling intelligence itself and bringing these models more, closer and closer to being, in some ways, as intelligent or more intelligent than people. And we think Anthropic's focus on that is where a lot of value over the long term in society, for people, for businesses, for the world, for the economy, where there's going to be real impact.
And Anthropic has that focus on safety. And Anthropic has that focus on enterprise.
They do.
Are you seeing, can you give examples of enterprises that are seeing real and tangible return on investment by backing and investing and embedding some of these models? Because I'm struggling to point to I can point to startups. I can point to Klarna, for example, where they're not having to have as many employees because they're embedding AI. But in terms of big enterprise, do you have examples?
The first place we're seeing that activity happen, and it is growing significantly, is in software development or coding. It makes logical sense. But in many large enterprises, the ability to let software developers be 10 times more productive in many cases, just because the models are smart and capable enough to write a lot of the mundane software and do some of the tasks that you take a really highly valued software engineer. They have to spend time on low-level tasks that may not be the best use of their time. There, we've already seen a massive change in what artificial intelligence can do to make people more productive. Other areas in certain verticals, we're seeing in the legal field, we're seeing actually initial stages of the medical field, where these models are able to offload tasks which have to do with sometimes writing summary briefs, sometimes listening to how a patient communicates to a doctor and just transcribing those notes. So there's a lot of tasks that people who are working in the knowledge economy, people who have tasks where, in addition to thinking, they have to do administrative tasks. The artificial intelligence can offload an enormous amount of that work even today, and this is before we've gotten to kind of the most intelligent models that we'll see in probably just a few years.
Yeah, and Dario Modi, the co-founder of Anthropic, has said pretty recently, a month ago or so, that he expects AGI, or artificial general intelligence, to be here in 2026. So essentially computers or algorithms or models that are as intelligent as the most intelligent humans. Do you align with that view in terms of the timing? What does that mean for society?
Well, I think the good news is when we talk about AGI, it's a little bit of an over-rotated term, but models that are highly, highly capable, we don't think that there will be the singularity where a model pops out and it is all-knowing, all-seeing, and just smarter than a human being in every way. But what is happening is if you take sort of very specific areas or domains, maybe it will be transcribing voice to text because lots of people need to take notes. Maybe it'll be in writing certain kinds of software. If you take these sort of specific problems, we will get to computers with artificial intelligence that can do the tasks better than people can. And the nice thing is once that happens in those domains, you can, in a very specific way, say, hey, if my responsibility includes this task, I can offload it and I can focus on things that are higher level tasks. So we are going to see that happening. We're starting to see it, and within a couple of years, we're going to start to understand what it means when you really have a computer, an artificial intelligence that can take certain areas of work responsibility and do them completely. And what does that mean for our ability as a society, for people to spend our time on other things? So we're absolutely going to see that.
Does your bet on Anthropic, is that a bet that Anthropic wins out versus OpenAI when it comes to the race for AGI?
We think Anthropic, our conviction, our investment really does stem from their focus on the frontier and the fact that there are a variety of important technologies. These aren't features, again, this is scaling intelligence itself. This is creating a way for computers to act very independently, which is we call agents. This is really technology to ensure that they're trustworthy, that they're understandable. All of those technologies together, those are the things that we believe Anthropic, and focusing on advancing the frontier of artificial intelligence, are going to have to happen. Those are the things, again, if businesses, if governments, if we're really going to take these intelligent computers and let them act in society in some independent way and affect our constituents, these things all have to be there. And Anthropic has a very maniacal mission to make sure that artificial intelligence is delivered that way.
Before we let you go, correct me if I'm wrong. There are reports that you've raised another $7 billion US. You're in the process of doing that for funds from your LPs. Can you confirm where you are in that fundraising and where are you putting that money to play, or where do you plan to put that money to play?
Unfortunately, I'm not allowed to comment on fundraising cycles for the firm, but Lightspeed is, as a firm, we invest in the most transformational technology trends. That's what's been Lightspeed's 25-year history, and we're really looking for places where technology, in a positive way, can be transformative to society. I'm sorry?
Does Europe excite you as a proposition?
Europe absolutely excites me. We have been active in Europe for many years now, and we see, again, extremely strong technological talent. We see a lot of strong artificial intelligence companies and people with deep research backgrounds. So Europe is a place where we're actively investing.
Ravi, thank you very much indeed. Ravi Mhatre, Lightspeed's founder, co-founder and partner, of course, at Lightspeed Venture Partners on the back of that $1 billion investment in Anthropic. We appreciate your time. There's plenty more coming up. Stay with us. This is Bloomberg.
I do factor in some effects of tariffs now on inflation, on prices.
We've not seen this level of tariff, at least in modern times.
I think these are going to adversely affect us with respect to inflation. They'll adversely affect us with respect to growth, adversely affect productivity.
The opinions on tariffs vary from they're incredibly inflationary to they are potentially contributing to a recession.
Gotta take that longer-term approach. Hope, or maybe expect at some point, that they'll get to outcomes, markets will calm.
I think what you can't control is consumer confidence and corporate confidence, and I think that is what is falling off a cliff right now.
Bloomberg Invest guests, including Federal Reserve Bank of New York President, Blackstone's President John Gray, and Soros Fund Management Dawn Fitzpatrick reacting to the news on tariffs. And here is the equity market reaction since Inauguration Day for President Trump. What Trump trade? The Trump trade has been sell stocks. You're down on the S&P about 2% since that time. Consumer sentiment's been hit. Jobless claims are up. Tariffs are potentially inflationary and, of course, a cap on growth. When, then, does the Trump put come into play? Is it a 10% correction? Is the S&P still the guardrails for this president? Remains a key question for these markets. Let's flip the board and have a look at the euro, because, my goodness, the changes coming through in Germany then, ripping up the debt brake. That's the plan, at least, to release hundreds of billions of euros into investment for defence and infrastructure spend. The euro getting to 106. Expectations from Deutsche Bank, you could get to 110. Deutsche Bank's analysts on the FX team suggesting this is the biggest fiscal change for Germany since reunification back, of course, to the late 1980s, 1989. Watch the euro, watch the defence stocks. Another huge day for these markets when it comes to how we think about the tremendous defence spend that seems to be in the pipeline now for Germany and Europe as well. The opening trade is up next. They'll be walking through all of this for you, of course, the market reaction to the tariffs and the Commerce Secretary suggesting that maybe there could be relief as soon as today for Mexico and Canada. The opening trade up next. This is Bloomberg.